So let's have consideration of laws and regulations affecting our client. So this is covered under PSA 250. So consideration of laws and regulations in an audit of financial statements. So in this regard, we have to consider the types of laws and regulations that could affect our client's operations and financial reporting. So as for the types of laws and regulations that could affect our client, we have the first type, we have the direct effect laws and regulations. So these laws and regulations can result to non-compliance, can result to amounts or disclosures that are reported in the financial statements of our clients. So example are tax laws and regulations. So and pension laws and regulations. So non-compliance to those type of rules and regulations can have a direct impact on the financial statements or on the amounts and disclosures reported on the financial statements of our clients. On the other hand, we also have indirect effect laws and regulations. So these laws and regulations would not have a direct effect on the entity's financial statements, but they affect the operations or the other aspect of the entity's business. However, even though this non-compliance with these laws and regulations may not directly affect the financial statements, it may have an indirect effect in a way of let's say penalty, or that the business may also be closed or cease to operate. So if the entity would not comply with this laws and regulation, so like what is stated here, it may result to fines, litigation, or even some consequences that could have a material effect on the entity's financial statements or even on their existence itself. So that is why, as part of our understanding, so we have to assess the possibility of the client's non-compliance with these laws and regulations. So when we say non-compliance with laws and regulation, so these are acts of omission or commission by the entity. So either intentional or unintentional. So because remember in our law, so ignorance of the law would not excuse you from the required compliance. So again, so these are omissions or commissions of an entity that are contrary to the prevailing laws and regulations. So take note that non-compliance, as far as the client is concerned, this is a source of their business risk. So like what we mentioned earlier in the discussion of business risk, so these are the circumstances that may prevent the entity from achieving their objectives. So therefore, it could affect them financially. For example, non-compliance with laws and regulations could have a financial impact, such as a penalty. So or even the entity may be put out of business. So because of this non-compliance with laws and regulation. And finally, the required understanding on our part is general understanding only. So meaning to say, we are not required to have thorough or comprehensive understanding of laws and of all the laws and regulations applicable to our client. So we should have a general understanding about laws and regulations that could affect their financial reporting. So as far as our responsibilities are concerned, we have to consider the effect of non-compliance to their financial statement. So we have to assess the impact, whether the impact is material or immaterial. If the impact of non-compliance is material to the financial statements of our client, so we have to ask the client to include that fact in their financial statements. In case the effect is immaterial, we have to consider the impact in the other aspect of the audit, like for example, the integrity of management, or the legal effect or consequence of non-compliance, such as, for example, possible cessation of the business of the entity. Now, finally, if the managed would not take remedial action with respect to non-compliance with laws and regulation, so regardless whether the effect in the financial statements is material or not material, we have to consider withdrawing from our engagement or ask legal advice what will be the best option or course of action on the part of the auditor. Now, the following are certain situations or red flags that we can encounter during our procedure, so related to possible non-compliance of our client with laws and regulations. So examples include number one, so payment of our client of unspecified services or loans to lawyers, consultant, related parties, or even government officials. So if we have encountered certain transactions without business rationale, then we have to consider the possible non-compliance on the part of our client. So another, we have payment for goods or services to a country other than where the goods originated or the services originated. So there are some risk, no? For example, that the client might be involved, for example, in smuggling, which is an illegal activity. So we have to consider this type of situation. So another, purchase or sale of goods or services from an entity or another company at a significantly higher or lower market price. And another information would be commissions or fees paid by the client beyond the reasonable amount related to that services or related to that type of transaction. Okay? Now, what are the audit procedures that are relevant related to detection of the auditor of this non-compliance with laws and regulation? So normally, we only use our existing understanding of laws and regulations applicable to the entity in understanding this situation that might cause possible non-compliance. We can also inquire from the management about their policies and procedures regarding their compliance with laws and regulations. So we can also inquire from them, from the management, laws and regulations that they may expect not to affect the operations of the entity. So because remember earlier, we are only required to have a general understanding of laws and regulations that could affect the financial reporting of the entity. But the best source of information about the other laws and regulations that could affect the operations of the entity would still be the management. And then we discussed to the management their policies and procedures that they have adopted to identify, evaluate, and account for litigations, claim, and assessment that may arise from this non-compliance. And then finally, we can also discuss legal and other regulatory framework with auditors of the component or other members if the company is a group, and to talk or discuss also with the auditors of the entities related parties located in other geographical area or segment. So for us to have a better understanding of the other laws and regulations that could affect the entities group, which could also impact the entity's financial statements. Okay, finally, to report identified or suspected non-compliance, so we have to consider once we have identified in our audit procedures. So remember earlier, we have indicators, and having discussed that with management, so depending on the result of our findings and courses of action, we have to consider whether we still have to report that incident to those charged with governance, particularly to the audit committee. So we also have to consider if there's a need to include that in our auditor's report. And finally, to government and enforcement authorities. So because we have certain regulations such as Anti-Money Laundering Act, or some rules of BSP and other government agency like Insurance Commission, that we have to report certain, let's say, instances in the company's operations or even financial results that would trigger now reporting to those different type of government agencies. So we have to consider those before we adopt a certain course of action. Next important planning activity that we will be discussing would be the establishment of materiality. So materiality is covered by PSA 320, an audit materiality. So first, let us discuss the concept of materiality. Materiality in audit is the maximum amounts of misstatements in the financial statements that could influence the decisions of the users. This materiality is affected not only by the size or amount or absolute amount of the misstatements, but also by the nature of the misstatements. And end of the day, what is material or considered material in an audit would depend on the auditor's professional judgment. Remember that our responsibility as auditor is to determine whether the financial statements are free from material misstatements. And therefore, materiality plays a big or significant role in this process of determining our opinion on the financial statements. So it's one of our major considerations in determining the appropriate report or opinion that we will be issuing in the financial statements of our client. And take note also that we consider not just the amount of the statements on the whole financial statements, but the smallest aggregate misstatement that could be material in any one of the financial statements. So even if this misstatement is material only, let's say, in statement of financial position, then that could already affect our opinion on the entire financial statements. So we reference this concept in the auditor's responsibility section of our audit report. So as mentioned earlier, materiality plays a big role in performing our procedures and evaluating the results of our procedures. We use materiality in all the phases in audit, so particularly in determining the material accounts and balances and disclosure, in during planning or planning phase of our audit. So we also use the concept of materiality in designing our audit procedures, in selecting samples that we will be examining or validating. We also use materiality, as mentioned earlier, in evaluating the effects of unrecorded misstatements after the client, for example, has corrected certain misstatements that we have proposed to them to be corrected. And ultimately, we use materiality in forming an opinion on the financial statements. In the next part, we will discuss the process of the auditor in establishing this materiality. The auditor determines materiality for the financial statements as a whole and materiality for particular class of transactions, account balances, or disclosure for the purpose of performing the audit procedures. So during planning, we make our preliminary judgment about materiality and determine the tolerable misstatement that will be applied in the performance of our audit procedure. And evaluating the results toward the conclusion of the audit, we estimate the likely misstatements and compare it with our preliminary judgment of materiality that we made during the risk assessment phase.